Morning, everybody. It's always tough to come after a speaker like Mike because he's so eloquent about covering kind of the key important parts of the material. I do want to definitely echo, as Mike said, thank you to Bitmain, Mr. Du and Mr. Joe. Thank you, Irene, everybody. We really appreciate the partnership. We value very much the partnership, and we value what you do for the industry, so thank you. We think the other services your group with Antpool and AntAlpha are delivering are very compelling for the industry. You know, what's unique about this industry is we're all actually in this together. It's not like we're competing against each other for a particular customer or that we each sell different solutions. We really just compete on capital, and we're all trying to do the same thing, which is mine Bitcoin so we can further secure the network. So it's great to have a company like Bitmain who really is investing in the industry and the ecosystem, so thank you. I'm going to talk about a topic that Mike sort of touched on, which is really, you know, to hold or not to hold, or to HODL or not to HODL. You know, is that really the question? And in times like this, where we are today in the market, it's really important to focus on smart financial management of your business. You know, when Bitcoin is doing nothing but going up, it's really easy to just keep investing, and when capital is available, you know, it's just a flywheel, you keep going. But shit happens, as we can see right now from where we are in the marketplace. And so it's really important to adopt a more pragmatic financial perspective. And maybe it's people with kind of more gray hair who've been through cycles, who have learned these lessons the hard way, who may seem more conservative in their approach, but that conservative approach sometimes pays off in the long run. So what I'm going to talk about today is kind of a way that we view whether we should hold or sell Bitcoin, and when it can make sense to sell Bitcoin to finance your growth. Because I do agree with Mike, there is no better time to build than in a down market. When we placed our initial large orders with Bitmain, it was in late 2020. And machine prices, rig prices were really low. And what we're seeing now is another opportunity where not only have prices come down, but also hosting capacity is more readily available. Granted, energy prices are very high right now. But if you can manage how you arrange your hosting and power agreements, there's no better time to invest. So, safe harbor statement, we're a public company. You can read this if you want to, but this basically says that what I'm saying here won't be non-public material information, et cetera. So, you know, the proverbial line from Shakespeare's Macbeth, you know, adapted for Bitcoin, to HODL or not to HODL, is that the question? Well, it kind of depends. You know, there are times when it makes sense to HODL and there are times when it doesn't. You know, Charles Dickens wrote a book, The Tale of Two Cities, and the opening line of that was, it was the best of times, it was the worst of times. And we're kind of in that type of a market today. So in the best of times, miners are focused on growing and hodling. Capital is readily available. Look at last year. Mike touched on the numbers, right? You know, cost of capital was super cheap. Everybody was throwing money at you. Energy prices were low, and capacity was abundant. It was easy to grow. People invested in infrastructure. They placed orders for miners. Well, the capital markets giveth and they taketh away. They pull the rug out from under you. If we look at how the change in capital markets has flipped in the last 12 months, it's amazing. Last year in November, we raised roughly $750 million in a convertible bond offering at 1% interest, unsecured, that converts into Marathon stock at a price of $76 a share. It most probably got priced at one of the top 3 days for our share price in Bitcoin last year. Super cheap cost of capital. And when your share price is going up at an accelerated rate, your cost of capital is fairly low. But in a market when it comes down, things have flipped. Debt is double digit for most people today if they're financing miners. Cost of capital is high. Equity markets are very hard to tap right now. And it's hard to raise money. And in the worst of times, miners focus on having to sell their Bitcoin to finance their growth. And when you think about it, selling when the market is down towards the bottom is the absolute worst time to be selling your Bitcoin. And so is there a better way to think about this? And yes, there is. So selling's typically been reactionary, not strategic. If you look at the small chart on the left, the publicly traded miners have sold off 23% of their Bitcoin in the last month alone. That's a pretty substantial amount of Bitcoin. It's over 10,000 BTC. Now, if they had been managing that Bitcoin all along, they wouldn't all have been hodling. They would have sold a portion of it along the way. And they likely would have been in better shape. But I think all of us were drinking the Kool-Aid last year and thinking, Bitcoin's just going to keep going up, and then after the correction, it'll keep going up again. But nobody really knows where this market's going to be. And so we need to adopt a form of financial planning that's a little bit more prudent. So what can we do better? For those of you who are finance people, weighted average cost of capital is a formula you use for basically determining what is the threshold at which an investment has to return, pay back, such that it covers the cost of the capital you're going to invest in that deal. Now, the formula here has a small little error between the two brackets of the first set of brackets and the second. There should be a plus sign, so I apologize for that. But essentially, what you're trying to do here is figure out what does it cost me to raise capital, to invest in miners, to invest in hosting capacity? And what does it cost me to hold the Bitcoin that I hold, or should I sell it? So think of it as it's a threshold. It's kind of like if you go to your investment advisor and you say, listen, I need to get 7% after-tax return to be able to retire when I'm 65, et cetera. That's a threshold. It's a hurdle rate they're going to have to try and meet in their investments. The weighted average cost of capital can be a little complicated if you're a public company because you've got to worry about the value of the equity and things like that. If you're a private company and the only cost of capital you have is essentially debt, then it's a lot easier. You just look at what does it cost you to service that debt from a perspective of cash flow and interest rate, and can you afford to generate a return that's greater than that debt? Think about all the people who invest in real estate. That's essentially the model they do, right? You find a piece of real estate, what's the cap rate? How much do you have to borrow to invest in that real estate? What the rent's going to return to you, and are you going to make a profit at the end of the day that lets you service the debt and after tax generate a profit? So you have more capital to invest in other things. Weighted average cost of capital is essentially the same calculus, but you're also including the cost of equity, because as a public company, our shareholders are expecting a return. And while we don't pay a dividend, most public companies don't, they're expecting the share price to increase and the value of the company to increase such that their investment is going to generate an expected return. And that expected return is typically viewed in the marketplace, if you would, as a multiple of earnings and growth, right? It's your kind of PE multiple. So you calculate your weighted average cost of capital, and that tells you what any investment you make, whether it's new miners and hosting capacity or whether it's holding your Bitcoin, whether you should do it or whether you shouldn't do it. Because if the return on an investment, when you risk adjust it, is going to generate less than your weighted average cost of capital, you're actually losing money. So how do we simplify this? Well, rather than asking whether you should HODL or not, first question, can you afford and do you have the capital today to cover your operating expenses, pay for your power, pay for your employees, pay for your CEO salary, et cetera, and the CapEx you're investing in? Do you have the cash available today to invest in the miners and the infrastructure or not? If you don't, then you need to look at the next question. Is the Bitcoin price going to grow faster or higher than your weighted average cost of capital? So if your weighted average cost of capital is, let's say, 20%, then the price of Bitcoin has to go up by more than 20% if you're going to hold it. Otherwise, you should sell it. If you don't have to worry about funding OPEX and CapEx, then as long as the price of Bitcoin is growing at greater than 0%, or if you really wanted to look at the kind of safe hurdle rate for capital, you could take that Bitcoin and invest that cash somewhere else, whatever that hurdle rate would generate for you. It's maybe 7, 8%. Then that'll help you decide whether you should hold or whether you should sell. So here's an example. Company has $20 million of debt. Their equity is about 80 million. It's the value of the company. The cost of that equity, meaning the expectation investors have, is that it'll grow at 20% a year. Your cost of debt is 12%, and your tax rate is 25%. You do the math, you end up with 17.8% as your weighted average cost of capital. Any investment you make has to generate more than 17.8%, or else it doesn't make sense. So if a mining company believes that the price of Bitcoin is going to grow at a faster rate than the 17.8%, it can make sense to HODL. Otherwise, they should sell the Bitcoin and use that to invest. It's pretty logical. So here's another way to look at it. Over a 60-month period from 2020 to 2025, 3 different miners. They have 500 petahash of capacity at 30 joules per terahash, paying 5 cents per kilowatt hour for electricity. One sells 100% of their Bitcoin, one sells 50% of their BTC, and then one HODLs everything. Here's the interesting thing, and this is basically based on BitUDA's projections for hash rate growth and the price of Bitcoin. The seller who sells 100% of their Bitcoin will generate about $101 million. The HODLer will only have about 91.5 million of Bitcoin, of profits from that. And the seller of 50% of their BTC will actually end up with the highest return, 115 million. And again, this is driven by your weighted average cost of capital. So as you think about holding or selling Bitcoin, get smart, look at the financial calculus, figure out what your weighted average cost of capital is, and decide, should I sell my Bitcoin? Or is Bitcoin going to grow at a much faster rate than my cost of capital? And should I therefore hold my Bitcoin? And for how long? So it's all about being strategic. And with that, thank you very much, and I'll take whatever questions anybody may have. Great. So the question was, don't you run the risk of being a speculator? By being a miner, you are a speculator, right? If you're even considering selling hash rate to somebody, you're speculating. By owning and holding Bitcoin, you are speculating. It's an asset, and you're speculating on its growth rate. Who better than a miner should have an understanding of where global hash rate's going to go and the price of Bitcoin? Much better than the layperson. So it really is a question of, are you willing to place a bet on your assumptions being right of where the market's going or not? If you don't feel confident in your own choices and your assumptions, then just sell your Bitcoin. That's your safest bet. But if you have a good feeling for where the price of Bitcoin is going to go and where the global hash rate is going to go, then it's easier to do. So great question. Other questions? Yes? Hedging or lending out your Bitcoin? Well, let's just say yield farming is not such a popular topic these days. And lending out your Bitcoin typically has, there's always counterparty risk, right? So there's this concept in finance called the risk-adjusted return. Right? And it's, people say, well, you know, private equity and venture capital returns much more than private equity. Well, it's actually not true. They're about the same when you adjust it for the risk. So with hedging, you know, you have to look at different hedging strategies. You can do call option straddles, which is a great way in an up market when there's good contango in the marketplace. You can lend out the Bitcoin. If you lend it to a reputable third party who has a strong balance sheet, it's going to be very small return rates. And so you have to really think about other ways of generating yield on it. But most probably the best strategy in a long market is selling just options on your Bitcoin. Especially out of the money market calls at 130, 140%. I'm not giving investment advice, by the way. This is purely my opinion, so caveat on that. But great question. Any other questions? One last one? Okay. Well, we are done. Thank you very much. Appreciate it.